This article is targeted to the intermediate and sophisticated traders who are already familiar with the basics of index arbitrage. There are other resources available on OKEx Academy if you need more explanations on the concepts of basis, margining and fair value calculation. Today, we're going to discuss a trade that would have returned greater than 10% last month. The idea is very similar to the borrow and carry trade discussed here. For ease of discussion, we assume that we build an index arbitrage position on February 12 and then unwind it on March 13 at the most favorable time. However, the meat of the discussion arises from the discussion of how to maximize return on capital and lower risk by using both OKEx's inverse and linear futures. The vanilla trading idea. The graphs below show the percentage basis on February 12 and March 13, 2020. Each graph includes the percent basis of both OKEx inverse coin margined USD futures and linear USDT margined futures. On a quick glance, we can see how linear future basis is consistently higher than the inverse future basis, which we will discuss later. This spread between the two BTC quarterly futures is driven by the external lending rate of the underlying and also how margining works. On February 12, the market was trading contango, near quarter futures were trading approximately 5% above spot price, and the trading floor lingo we should use is that the futures were trading rich. 1 month later on March 13, the market traded at backwardation, with near quarter futures trading at trough of approximately -15%, both futures were trading cheap. The trade is to buy spot and sell rich futures on February 12 and then unwind by selling spot and buying back cheap futures on March 13 for a hefty 20% return for a 1-month holding period. The idea of this index arbitrage trade is quite simple, but the devil is in the details. Maximizing capital usage and maximizing profit timing the basis is impossible, so you don't expect to truly make this 20%. Since we are not able to predict futures basis and don't know when is the exact time to build and unwind our inventory, let's take a look at other parts of the equation, which futures to use and why. We will now turn our attention to maximizing our return per capital and lowering our risks. Nuance 1. If inverse and linear futures have the same positive basis, it is better to use inverse futures to build index arbitrage position. OKEx is the only exchange that offers both inverse and linear futures. The margin of these BTC futures is BTC and USDT respectively. Now, assume you have $10,000 for arbitrage, which means you can buy $10,000 worth of BTC and sell $10,000 worth of BTC futures. Which future should you use? The USDT future actually has a higher basis of approximately 0.7 due to their margin requirements. If you choose inverse futures, you would buy $10,000 of BTC and use it as the future collateral. Essentially, you would never get forced liquidated because of the inverse payout nature. See example 1. Example 1, assume fee equals 0, leverage equals 10x, entered at 15 hours 0 minutes and 0 seconds on February 13, the liquidation price is infinite. Assume we hold the position until expiry and unwind the spot position and settle the future at the same price, and 1 USDT equals $1, your return will be approximately 5%, which will be around 0.0492 BTC, $513. If you decided to capture more basis with the linear USDT futures, you need to reserve a significant amount of cash and buy USDT to margin the linear future. For index arbitrage position, the basis captured would be more, but per capital usage, you captured less dollar basis. Most importantly, there is a chance you could get forced liquidated if the market shoots up, because there are unlimited downside shorting futures. Nuance 2. If inverse and linear futures have the same negative basis, it is better to use linear futures to unwind index arbitrage position. Conversely, if both inverse and linear futures are trading at a discount to spot, which futures should you use and why? Following the above logic, all things else equal, you should use the linear future to build a reverse arbitrage position, sell spot buy future. When you sell spot in the OKEx spot market, you get back USDT. Using this USDT, you can do 1-to-1 margin of your long future position. You will essentially never be forced liquidated unless market drops 1 mmr%. See example 2. Example 2, assume fee equals 0, leverage equals 10x, entered at 8 hours 0 minutes and 0 seconds on March 13, liquidation price would be around approximately 20. If unwind during expiry on March 27, and assuming the linear future settles at $4,794, your return will be 8.4%, which will be around $840 USDT. Nuance 3, to maximize capital usage and use leverage, you can do a mix of sell inverse futures, buy linear futures. Assuming 1 USDT equals $1, Nuances 1 and 2 explains why linear futures should consistently price higher than inverse futures. If you are capital strapped, you can try trading the spread of the futures. For example, if there is a lower demand for linear futures in the market than inverse futures, then the BA